This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your Forex Report. We are wrapping up the week on Friday, August 3rd, 2007. The greenback is ending the week on a sour note after finding very little support in the broad market in recent days. U.S. data has simply left the dollar out to dry as one report after another suggests the economy may not be quite on track. The only number that came in stronger than expected this week was consumer confidence, which many traders use as a contrarian indicator. Reports published earlier this week that missed estimates included Chicago PMI, PCE, and ISM manufacturing. Most of the downward surprises were significant and raised doubts about growth in the second half of this year. Today's data was also worse than expected, with payrolls coming in shy of forecast, the unemployment rate surprisingly ticking higher, and ISM non-manufacturing falling more than expected to 55.8. Well, some stock traders said this confirms the Goldilocks, not too hot, not too cold outlook. It appears as though Forex traders see it differently. Other important news and events this week around the world may also point towards further declines in the dollar. In contrast to the U.S. economy, there are still signs of robust growth in many G7 economies, and rate hikes are still expected from a few. While some European data has been mixed recently, ECB President Trichet said yesterday that a rate hike in September was likely. The bull market in commodities is not expected to fade quickly either, which should help keep the Aussie, CAD, and Kiwi supported for now. Therefore, even with the dollar trading near multi-decade lows against a handful of currencies, the fundamental backdrop could support a further sell-off as early as next week. Now to the big picture. Well, it turned out to be a tough week for the U.S. dollar, much more difficult than we expected coming in. Last week, we saw some very sharp corrections in yen carry trades as stocks around the world fell and traders bailed on riskier holdings. This helped the greenback gain some traction in the broad market, albeit somewhat by default. While we're not necessarily looking for a repeat this week, we did not foresee such a quick decline in the buck. Carry trades have merely consolidated for the most part, with a mix of ups and downs in the last 5 days. Meanwhile, the dollar is back under heavy pressure in many pairs and could be on course to resume its latest downtrend after only 1 week of recovering. We are not completely convinced just yet, however, as so many of the greenback's counterparts still appear very top-heavy and overbought. Traders have been aggressively pricing in or discounting lofty growth and rate hike expectations of other currencies, and the underlying economies must now produce impeccable numbers. Otherwise, traders may be prompted to take profits, thus allowing the dollar to rebound. Therefore, we expect that incoming data from all economies will play a big role in coming weeks and months in determining whether the downtrend in the U.S. currency continues. Meanwhile, any further unwinding of carry trades should help support the dollar once again, as it did last week, a scenario that was absent today. Till next week, enjoy your weekend and take care.